This is Bloomberg Businessweek Daily, reporting from the magazine that helps global leaders stay ahead, with insight on the people, companies, and trends shaping today's complex economy, plus global business, finance, and tech news as it happens. Bloomberg Businessweek Daily with Massar and Tim Stenovec, live on Bloomberg Radio, television, YouTube, and Bloomberg Originals.
And a very good afternoon, everybody, across Bloomberg platforms. I'm Massar along with Tim Stenovec, live here at Bloomberg headquarters in New York City. It's kind of a Fed Wednesday, actually, a Fed Beige Book Wednesday. We are awaiting those headlines to cross the Bloomberg terminal. They're anecdotes from business members, economists, you name it. And it's just kind of data that gives us a snapshot of where we are in the U.S. economy.
Yeah, we're going to bring you some of the headlines when we do get them. Also, Stuart Paul standing by. He's going to give us some context when those headlines do cross. Also, Carol, speaking of reads on the U.S. economy, we got a billionaire developer, Rick Caruso, joining us a little bit later this hour. He's founder and executive chairman of Caruso. He's going to talk the property markets, development, also a little about today's politics. So remember, he ran for mayor of Los Angeles back in 2022.
All right, so we're going to talk to him. He will give us a vantage point on the U.S. economy. We're also going to get another read when it comes to what's going on here in the U.S. when it comes to growth or lack thereof. We're going to hear about the consumer. We're going to hear about tariffs. We're going to hear about a lot more from the CEO of the VF Corporation. They have a bunch of brands under their umbrella, so we'll see what he has to say a little bit later on this hour.
Also, how does this make the U.S. a market investable or not? That's the big question. We're going to speak with the chief investment officer over at BNY Mellon on all that, Carol, and more.
Still waiting for those Beige Book headlines to cross. We'll get to that in just a moment. First up, your market setup on this Fed Wednesday. Here is Lisa Mateo in for Charlie Pellet.
Yeah, we are waiting for those headlines. Right now, we have a bit of a mixed look on Wall Street. Alphabet giving tech stocks a boost. This is after that judge ruled Google can retain control of Chrome and its partnership with Apple, but has to share some search data with rivals. Right now, shares of Alphabet, they're up about 8%. Apple shares up more than 3%. Heading over to the NASDAQ, up about 0.5%, 125 points. We go to the S&P 500. Right now, it's little change, up about 3 points, and the Dow down 0.6%, 284 points. The sell-off in government debt, well, it lost some momentum. The yield on 30-year treasuries came close to 5% before erasing that advance. We'll start with the 30-year at 4.89%, down 5 basis points. The yield on the 10-year, 4.21%. That's down 5 basis points. And the yield on the 2-year, 3.61%, and that's down about 3 basis points. The Bloomberg Dollar Spot Index down about 0.1%. To earnings we go. Right now, we'll start with Macy's. Their shares are up about 17%. It raised its annual outlook, reported its best comparable sales growth in 3 years. And its CEO said the company's back-to-school season is off to a good start. And shares of Dollar Tree, they're lower this morning. They're down about 9%. Discount chain said profit for the current quarter would be little change, but that kind of overshadowed news that the company actually boosted its annual outlook. For on-demand news 24 hours a day, subscribe to Bloomberg News Now, wherever you get your podcasts. I'm Lisa Mateo. That is a Bloomberg Business Flash.
All right, folks, the Beige Book is out, published 8 times a year, 51 pages, just crossing the Bloomberg terminal, and it's all about anecdotal information on the current economic conditions. So let's get to it. Deeper analysis with our own Stuart Paul, U.S. and Canada economist for Bloomberg Economics. He's here in our Bloomberg studio. All right, so what jumps out at you, Stuart?
All told, this Beige Book released just today is overall more negative than everything that we saw in July. Most of the 12 Federal Reserve districts reported little or no change in economic activity overall. Most notably, real wage growth seems to be dismal, and it's weighing on consumer spending and consumer activity. Focusing on those wages and the labor market that's producing those wages, 11 of the 12 Federal Reserve districts describe little or no net change in overall employment levels, corroborating basically what we've seen in the payrolls over the last several months. Looking at prices, a little bit more inflationary than everything we saw in July. 10 of the 12 districts characterize price growth as moderate or modest. The other 2 districts, strong input price growth that's outpacing moderate or modest selling prices. And that's going to be the thing that we're going to be thinking about with the inflation landscape going forward. There are some tariff price pressures that are going into the pipeline, and the question is just how much can consumers allow those prices to rise before demand retrenches. And the Beige Book right now is showing that demand is retrenching because of weakening real wages.
On that, Stuart, reading from the Beige Book, it says, quote, contacts frequently cited economic uncertainty and tariffs as negative factors. New York reported that, quote, consumers were being squeezed by rising costs of insurance, utilities, and other expenses. The Beige Book also noting that contacts reported flat to declining consumer spending because for many households, wages were failing to keep up with rising prices. What does all of this mean for the Fed meeting later this month and that 25 basis point cut that pretty much everyone out there is expecting?
Everyone's expecting it, but what this really ends up coming down to is counting the votes on the FOMC on that monetary policy making committee. So one of the things that's nice about the Beige Book, we get to look at activity in each of the Federal Reserve districts. I think for September, the most important district is Kansas City. Jeffrey Schmid, a voter, president of the Federal Reserve Bank of Kansas City. Right now, we're seeing that economic activity was generally flat. Employment declined modestly. Wage pressures remained subdued. All of those factors might mean that one of the most hawkish voters on the committee could be a little bit more open to the idea of voting for a cut. You could see that true coalition building around exactly what Governor Waller wants, what San Francisco Fed President Daly has said she is wide open to, and that's a cut at this upcoming meeting.
Are you saying because he's been so hawkish and that he's seeing moderate activity, that's why this is an interesting Fed governor to focus on?
That's exactly right. He's one of the, he is, by our natural language processing tools, the most hawkish member of the committee. He is a voter, and conditions locally are weak. Conditions locally likely warrant a cut in his eyes.
Do conditions locally inform the way that voting members of the Federal Reserve who represent certain districts will vote? Is that their responsibility? Is that their job to represent their districts?
It's not specifically enumerated in the Federal Reserve Act that they must set policy according to conditions locally, but the reason why the districts are divided up the way they are is so that everybody around the country has someone who is representing their interest. And similarly, there are requirements on the Board of Governors that the composition of the governors are supposed to represent conditions around the country. So these are important qualitative aspects of local conditions that feed into the decision-making process. Do we know for certain how any one person is going to vote? No, certainly not. But when we see conditions cooling in a district that is presided over by one of the more hawkish members, you would think they might start pivoting a little bit more dovish, and we can see that coalition building around a cut in September.
Let's not forget, we get some inflation prints before the next Fed decision. We get the monthly jobs report on Friday. There's a lot that still could come to the Fed that could impact their decision. The other thing, though, and let me just roll this into it, Stuart, this possible legal rollback of tariffs, which could be, this is a major uncertainty. I know the president said yesterday some urgency to make this decision, like, let's figure this out sooner rather than later. Is the Fed going to err on the side of holding off on any kind of move because there is still some uncertainty? Are there enough evidence or a growing number of evidence that the economy is slowing that it does make sense to cut rates of some sort?
I think that there is enough evidence that's been accumulated when you look across the broad swath of indicators, whether it's real wage growth, whether it's the pace of hiring, whether it's some of the anecdotal data that we're getting just today, that a cut is warranted. The question is whether they want to do it in September or whether they want to do it a little bit further down the line. From an economic perspective, it doesn't matter that much. They could wait until December if they wanted to. They could wait until 2016 if they wanted to. But it looks like the coalition probably is there based on the data that we're seeing, based on the anecdotes that we're seeing, to deliver a cut in September.
Stephen Myron, right? We've got a hearing tomorrow. President Trump is very eager to get him in place on the Fed board. How might that change some of the composition and change all of the discussions that happen around the table at the Fed?
You know that you'd get another voice that's advocating for a cut. And I expect that he will be confirmed in time to vote on the 17th. And again, it's just part of that coalition that's building.
All right, we're going to leave it there. So appreciated. Our own Stuart Paul, U.S. and Canada economist at Bloomberg Economics, right here in our studio. All right, folks, we're going to kind of stay with our major backdrop and go kind of from the economy to what this all means for the financial market backdrop. We've got a great guest. We want to get into how the data, the White House, the geopolitics continue to shape the investment environment, and we do have a good voice on that. Jason Granet is with us, Chief Investment Officer, BNY, here in studio. Great to be with you. How are you?
Oh, great to be with you. Since last time I saw you, hope you enjoyed your summer.
I've had a good summer. I can't believe it's September. I'm kind of bracing for what September might bring.
Yeah, back to school has kind of hit me over the head as well.
Exactly. Well, for the first time, I don't have somebody going back to school in a while. Tell me how you're thinking, because I go back to when we were together in June at Insight, BNY Insight 2025. You and I spoke up on the stage after Kellyanne Conway, senior counselor to the president, and we talked a lot about presidential policies and what it means for the investment environment. What's changed since early June to now in terms of the investment environment and how presidential policies are impacting it? Has it gotten more certain, less uncertain?
So, first of all, a lot has changed and nothing has changed all at the same time, right? We still have a very fast-paced, fluid policy environment where it feels like every day or every few hours there's some other news to digest and process and what that means for markets. On the flip side, we have a lot more certainty because a lot of tails and a lot of weird outcomes have been taken off the table. And so one thing that's amazing to me is the 20 weeks leading up to right before Labor Day was the single biggest drop in the VIX ever over a 20-week period. So you go back 20 weeks from the early spring through the end of the summer, and to think about all the things that happened, to have the greatest drop in volatility over that period is kind of amazing. That's
amazing good, amazing bad. Complacency always makes me a little nervous.
Yes, but we've also seen record highs in assets. You've seen some other things. Now, one big trend has taken hold on the curve, and that's the curve's gotten much steeper. In the month of August alone, 2s, 10s went from 40 to 60. That's a proper move over the course of a month. And so you have steeple curves. I heard you just discussing with your economist here. Obviously, because we're expecting easing cycle to start here in the U.S. I think to me it's more about pace of what's going to happen than if it will happen. But those have been some of the biggest changes in the operating environment from the beginning of the summer.
I was surprised that you didn't say the so-called big, beautiful bill being signed into law, because that was a question in June that a lot of people had, whether or not the president would get that past the finish line. And he did, signing into law in the early part of July. Does that remove uncertainty from the investing environment?
Well, it definitely removed uncertainty because it took some of the debt ceiling and some of the treasury market kind of tails off the table. But actually, quite frankly, when the one big, beautiful bill was signed, there were lots of compromises made, if it feels like ages ago now, but some compromises made over the last few weeks. And actually it looked more like the ecosystem before than after. So while the uncertainty of if will it get done, what will happen was cleared, and we took some debt ceiling things off the table. And I think that's definitely one of the things that's contributed to this broader drop in volatility, is that these things have just been cleared from the environment.
Do you see a slowdown in the economy? Do you see weakness in growth? Do you see weakness in labor?
So I don't see a lot of it. So for example, GDP second quarter was revised up. 3.3 is not something that my economics teachers would tell me to get nervous about. The labor market, clearly, Chair Powell communicated some uncertainty there. But as I joke with the team, if you were an alien studying economics and landed and looked at the data and what it looked like, you wouldn't necessarily see a lot of weakness. Today's JOLTS figures from this morning showed a small, but that's a noisy time series. That's not exactly the most linear time series to look at over the course of time. So, while we might be starting to see some of it, to say I see weakness would not be, where I'm at.
So what struck me in early June, speaking with Kellyanne Conway first and then talking with you, but it seemed overwhelming to me that the audience was like, it's time for a rate cut. And I remember even I feel like cheering when it was mentioned. But from what you're saying, that things are strong enough that maybe we don't need a rate cut. What's your informed view on what the Fed needs to do right now.
I appreciate being informed.
You're welcome.
A few things. One is I have sympathy with the view that policies on more maybe tight than not. And so if you want to look at it from a perspective of, all right, we can take some rates out to get closer to a more neutral stance. I'm neither here nor there. I have sympathy with that view. Look, we still have inflation that is on the stickier side. I think the trend has started to trend up, not continue the trend down. Core is still pushing 3, not 2,
right,
which our friends at the Fed would prefer. The unemployment story and the labor story headline seems to be holding up fine. As I mentioned, 3.3% growth is not a story, but so to me, I wouldn't be in the most rush to take rates down so fast. And by the way, sorry, Tim, the market here is telling you that we're not going to get to that different of a place. 1 year is still around 3%. It's been this 290 to 310. Even with all these gyrations and moves, where we're going to land has not really changed out on the horizon. And so I think that makes sense.
Jason, on the labor market, I want to home in on this and talk a little bit about immigration and immigration policy and the actual effects of immigration policy, the crackdown on illegal immigration, and in your view, what that is or could do to the economy, and also the crackdown on not necessarily legal immigration, but a decline in interest of people who are not in the United States coming to work in the United States, as we've seen over the last few months. What does that do to the economy?
Yeah, so 2 things I'm thinking about from that perspective. Number one, because you're changing the denominator here, maybe the amount of monthly job ads is lower than previously expected.
We've heard this a lot from people.
And so if people were expecting over 100K, if we get something closer to what's expected here this Friday at 60K, that might not be a degradation in the labor as much as kind of your old time series might tell you should look at. That's number one. The second is that the expectation is this would flow through somewhere on wage pressure, and so would that show up in the inflation story? We're seeing. I don't know if it would show up so much in services, which was a little bit higher this time, but the inflation story is still, like I said, sticky. But this is more on the core side, not necessarily on the labor side. But that's where I would watch to see if it really shows up.
You guys are such an important firm. You see so much in terms of money flows, investment flows. I don't know. What is that telling you about kind of where we are? Because I do think there's still some questions about what happens from here.
Yeah. So look, there's been 2 themes that have been very obvious. One you've seen in the markets. You saw the dollar's down 10%. That's a line from the upper left of your paper to the bottom right of your paper. And that's been somewhat consistent. And the steeper curve has been somewhat consistent. Those have been 2 constant drum beats, no matter what the headlines things are over the many, many months. Those 2 things have been in place. One of the things that we have seen in our data, people got very excited about the flows around the world in April.
Outside of the U.S.
But if you go back a year to last summer, over a year, so we have an iFlow product that the team there is wonderful. They do amazing analysis across the data to see what happens. And what we saw was actually there were our scored flows showed out from dollar assets going back to last summer and kind of, obviously ups and downs, but the trend. And I'd say it's leveled off more recently, and that now aligns with what we see in the tick data, that you're not seeing the big outflows. So while we saw that trend,
but is the money that went out coming back?
Not necessarily, but it's not flowing out, and I think that's what's showing up in markets.
I have to squeeze. My producer's going to be mad at me. But are you concerned about the independence of the Fed? It was something that we talked about in early June. We talked about with Kelly and Conway. Just got about 25 seconds.
Yeah. So look, I look at this about how the market's pricing it. The market's seeing that we're getting to 3%, either before or after any of these things. So the market's saying we're gonna get to a fair neutral or R-star or neutral rate over a period of time. It might come faster or slower, but that's where we're headed. And I think the market will tell you if there's more concern.
Okay. So good to see you again.
Great to see you.
Yeah. Happy September. Jason Granet, Chief Investment Officer of BNY. Hey, coming up next, we get another read on the U.S. economy, the reality of retail. We've got the CEO of VF Corporation. That's next.
It is 2:21 on Wall Street. I'm Lisa Mateo. Well, worries over inflation, debt sales, that triggered a global sell-off in bonds this week. Borrowers worldwide, they sold at least $90 billion in investment-grade debt yesterday. Today, weak labor data, well, that sparked some gains in bonds. We'll get to that data in just a second. Right now, we're taking you to the yield space, because the 30-year was near 5% earlier. It's now at 4.89%. That's down 5 basis points. The yield on the 10-year, 4.21%, and that's down 5 basis points. The 2-year, 3.61%, and that's down 3 basis points. Now to the data. We're talking about U.S. job openings. They fell in July to the lowest in 10 months. Companies became a little bit more cautious, selective with their hiring. The pullback driven by healthcare, retail, trade, and leisure and hospitality comes ahead of Friday's non-farm payrolls report. And the Fed's Beige Book showed most districts see little or no growth. So we've got stocks mixed right now. The NASDAQ up about 0.5%, 120 points. The S&P 500 little changed, up 4, and the Dow down about 0.5%, 242 points. For on-demand news 24 hours a day, you can subscribe to Bloomberg News Now. Wherever you get your podcasts, I'm Lisa Mateo. That is a Bloomberg Business Flash.
All right, Lisa Mateo, thank you so much. You are listening and watching Bloomberg Businessweek Daily. I'm Carol Massar, along with Tim Stenovec, live here at Bloomberg headquarters in New York City. We really thought about this hour, how it is about different reads on the U.S. economy. And we just had a great conversation with Jason Granet over at BNY, kind of adding it all up in terms of what it means for the market environment and certainly for investing. But we started it off with the Fed Beige Book, which gave us some anecdotal evidence. And as we heard from our Stuart Paul, a little bit more negative than we've heard in the past.
Yeah, a little later this hour, too, we're going to be speaking with Rick Caruso. He's the billionaire developer behind the Caruso companies. You know him if you've been at all in Los Angeles or Southern California. Maybe you've been to the Grove.
Tim has.
Or Montecito in the Miramar resort that he has developed there. So get a good read on what's happening in Southern California, especially post-Palisades fire. And now that California's fire season is year-round. Know that he is watching that very closely.
So in just a moment, we are going to actually get a good read on what's going on in the retail environment. And we know not all retail is the same, but we're going to check in with the CEO of VF Corp, and they've got some well-known brands certainly under their portfolio. We're talking about the North Face, we're talking about Timberland, Vans, Dickies, Kipling, and more. And when you think about retail, there are supply chains. Tariff certainly is an issue that has come into what's going on at the nation's retailers, but it also, Tim, gives you a read on consumer and consumer demand. And
that's exactly why we're talking about the Beige Book and getting a good understanding of what the consumer is experiencing right now. That Beige Book giving us some anecdotal evidence of what consumers and companies are experiencing in different parts of the country. As we did hear from Stuart Paul reminding us earlier that consumers are feeling squeezed in some areas of the country, especially with increased costs and things like insurance, fuel, and other things, with salaries not necessarily keeping up, Carol.
Yeah, listen, I mean, all of these things you put into the equation to figure out what happens next in terms of U.S. economic growth. You know, we've talked a lot about the possibility of the presidential tariffs being rolled back. What would that mean? Certainly for companies, what it would mean going forward. There's been some concerns about those tariffs being inflationary. All of this comes together when the Fed meets and makes that decision on September 17th. It's now just 2 weeks away. I mean, fast forward 2 weeks, and we will be talking about that Fed decision. Markets are expecting a Fed rate cut. We also saw that certainly with that JOLTS numbers this morning, a little bit more weakness, that the expectations kind of moved up here. So all of this will play together, and then what kind of market environment this creates, certainly for investors.
Let's talk a little bit about that JOLTS report, because the slide that we saw in vacancies, it's indicating, Carol, that companies are becoming more cautious and selective with their hiring. They're attempting to gauge the impact of tariffs on the economy and get an understanding for what exactly that's going to do to the economy, what it's going to do to consumer spending. In addition to the openings data, the pace of hiring has slowed. It's also taken longer for unemployed people to find another position. That's data that we're getting, but it's also anecdotal that I'm hearing from people who are looking for jobs right now. They're applying to more jobs. They're not necessarily hearing back from companies that they apply to, and they're still waiting to get that job.
It's fascinating because I just came back from a couple of weeks on vacation, and there were instances, and I had a lot of conversations with folks, with people saying they couldn't get workers, a lack of workers. So that's why that Friday's jobs report is so important. All right, the Goldman Sachs 32nd Annual Retailing Conference, it is underway. It highlights how consumers are responding across sectors and convenes key players from the global retail landscape. Bloomberg TV's Lisa Abramowicz is on location speaking with some of the biggest names in the industry, and she right now has a special guest. Lisa, all yours.
Thank you so much, Carol. Right now, I am here at the Goldman Sachs Retailing Conference with Darrell Darrell, excuse me, I get it wrong, of VF Corp, the CEO of VF Corp. That is home to the brands that you know and love, like Timberland, as well as, of course, North Face. Thank you so much for taking the time. I want to just start with the idea of where we are in terms of the retailing cycle, given the fact that back to school seems to be going okay. That's what we heard from Macy's this morning. That's what we've heard from the likes of Walmart. Are you seeing the same thing?
You know, we're in the middle of a quiet period, so I can't really talk about it. What I can say is, with so much change in the macro backdrop between tariffs and all the other things we talk about, I feel more confident than ever about what we're doing. So which is kind of ironic.
Well, it's sort of ironic at a time when consumers are supposed to be feeling bad because of tariffs, because of some of the inflationary pressures. Do you feel like consumers are strong enough to absorb some of the price increases that we've heard about?
Yeah, I think they probably are. I also think Doug McMillon, CEO of Walmart, said something, I think it was last week, about the pace at which the tariffs have been filtered in has been slow enough that it's been a little hard to notice. So you didn't walk into the store and see a price change right away, even though the tariffs were talked about the hour before. So I think that's probably helped make it a little more palatable for consumers.
Well, is it making it more palatable for you? Because it might be slow, but they are there. How are you passing them along? Are you passing them along in pricing? Are you passing it along and just absorbing it on your margins?
And we have so much internally that we can work on, from cost to pricing, strategic pricing, that we are very confident we'll offset the tariff impact by sometime next year. And it'll cause a little impact this year, but we're not too worried about it.
How much are you seeing sort of this choiceful, and this word that people use, choiceful or selective, or looking for a deal type of attitude from consumers versus what's cool?
Well, it's interesting. So our promotion levels are down versus a year ago, by the way. And we're in the business of trying to sell things that are cool. So I think it always feels like people are looking for cool things to us. And across our brands, Timberland, the North Face, Vans, all of them are about trying to create cool products with cool marketing. So far, so good. I don't think that people have traded down to choiceful from cool yet.
So are you able to raise prices? Are you planning on raising prices?
Yeah, we will raise prices, but it'll be very selective, and it'll be over time. So it won't be a sudden, turn on the lights, the prices are going up. It'll be very, very strategic, and we're going to follow where the market goes. We're not going to try to lead it.
I will say it is back to school season, and I have kids who are going back to school, and I see you're wearing a Dickies shirt. And I will say they're not wearing Dickies, they're wearing Timberland, and they're wearing North Face and other things. Do you have a favorite brand? I know you can't have a favorite child, but do you have expectations of one brand that potentially will lead growth for the next year or so?
As you said, I've got 3 children, and they're all my favorite. All these brands are my favorite. If you ask me which one am I most excited about from a growth standpoint, I refuse to answer that. But I will say that Altra, the brand you didn't mention, is a running shoe brand that's absolutely on fire, and it's a tremendous running shoe for off-road, on-road, doesn't matter. And it grew 20% last quarter. It's on fire. But I feel really, really good about all of our brands. All 3 of the ones you mentioned, I think they're all going to do well.
What about Vans? Because I remember Vans from when I was in high school, and it hasn't changed much in terms of its reputation, but you've talked about a turnaround plan. What does that turnaround plan look like, and how far into it are you?
Well, it starts with getting great people, and we've got a great leader of our Vans business. She came from Lululemon. She's the head of product. And then it goes back to the basics, which is amazing product. We just have to have more new product out there for consumers. People still, the same people who loved Vans before still love Vans, but they just haven't seen something new from us enough. So we've got a couple of new products that have come. The Super Low Pro is a really low profile shoe. It's selling really well. New School is really doing well, and that is a puffy version of kind of the old school. And then on top of that, we've got some other cool things happening. Like SZA is now artistic director, if you can imagine that. She's really, really interesting.
For Vans?
Yeah.
Okay, so this is sort of goes to what's cool, what's popular. And there was this sort of androgynous phase, and now we seem to be shifting into something else. What's sort of the latest thing that's catching on?
Well, I think the cool thing about where we are today is that slowly everybody's becoming creative. Or maybe we were always creative and getting to be a creative. And so people can be more expressive. So For a while, you'd see one brand of shoes on everybody's feet. Now there's this fragmentation, which is wonderful, and people are making choices. They can be expressive about who they are. I think that's the new world we're in, and I love that world because it is about creativity and self-expression and uniqueness, and every person is unique.
So you have 11 brands now. There's been some brands that you've let go of, some brands that you acquired over the past decades before you even got there. What's next? Are you planning to acquire more? Do you have plans for that? What's your sort of schedule for that?
In the near term, no. In the near term, we're going to bring down our debt levels to bring our leverage down, and we're going to get these big brands growing strongly. So that's really our game plan. So Timberland's already growing, North Face is already growing. We'll get Vans growing again. Ultra's growing fast. Dickies will grow. So that's really our game plan. And then once we get that going, then we'll look at acquiring new things again. But for now, we've got plenty of growth in the existing business.
How much advantage is there to being big right now, especially with the tariffs, with this question of technology and how it gets deployed?
Well, I think the biggest advantage of being big is that you get to learn across multiple places. So we have 11 brands, and we use 11 brands to learn on, 80 countries to learn from, and the ability to feed all that back and upgrade the whole system. That's really the advantage of scale right now, and we're really trying to take full advantage of it.
How much are you seeing AI sort of creep into that also in terms of efficiencies of scale and using algorithmic learning to better process data, to better process sales, et cetera?
I'm seeing it everywhere. We have AI experiments going on in virtually every part of our business. They're all relatively small scale, except one or two today, but they'll keep growing. And they're just major abilities to enable people to be more creative and to leverage scale and enable us to invest back in things that can really drive growth and more product creation things. So I'm very excited about AI over the next 5 to 10 years. I think it's going to transform every business, including ours, and every function of the business.
Do you think that it's going to reduce the employee base?
You know, that's the big question everybody's asking. I think the reality is it will enable every person to do a lot more. And that could be translated into a smaller consumer base, or a smaller employee base, or it could be translated into a bigger revenue base with the same number of employees or more. That's what I want to do. I want a much bigger business. We're all about growth.
You know, one thing that we've heard a lot about is that President Trump's tariffs have sort of soured a lot of consumers around the world on the brand Americana, and that it could lead a lot of countries and people in other countries to not buy U.S. goods or things that are associated with the United States. Have you seen any evidence of that whatsoever?
No, I haven't. And we actually survey China to look for exactly that. And I will say so far, you know, we're not seeing signs of that. There's no boycott America movement of any scale that's emerged. But we're always keeping an eye on that. And I mean, the cool thing is that you know, brands are, especially the fashion brands, are often almost seen as independent of country. They almost are their own countries. They almost stand for themselves. And we're a very democratic set of countries because these are small, affordable brands. Not small, but they're affordable brands that everybody can afford, you know? And so I love the North Face, Timberland, Dickies, Vans, all of them for that reason.
Have you changed your supply chains at all in response to all of this?
We've shifted some supply from one country to another one, but generally speaking, the whole industry is hit by the same set of tariffs that affect all the same set of countries where we all manufacture. So it's the most egalitarian impact you could possibly have, which in a way is really good because that means we all are forced to face the same thing. We all got to do the same things, and there'll be variation in how we execute, but in the end, we'll end up at the same place.
Before we go, a lot of people here are trying to sound confident, and I respect that. It seems like everything's been thrown up in the air, especially given all of these policy decisions. You started the conversation saying you're surprised that things are as stable as they are. How much does the court ruling about tariffs change the game? The idea that you don't even know what tariffs are going to come on or what tariffs are going to go off or what the regime is going to be in 6 months.
Look, we have so much opportunity to control our own destiny. We have so many things we can work on without worrying about any of this macro stuff that it really won't matter in the medium term. For us, it won't matter. We've just got to execute. If we execute, I'm not worried about any of that.
Bracken, thank you so much for being with us. Bracken Darrell, the CEO of VF Corp, here with us at the Goldman Sachs conference. I'll turn it back to you, Carol and Tim.
All right, we will take it. Lisa Abramowicz, thank you so much. So appreciate And there with the CEO of VF Corp, a lot of known brands, certainly under their umbrella, the North Face, Timberland, Vans, Dickies, Kipling, and more. He also talked about a running shoe brand, Ultra. And so really digging into things that are certainly pertinent to retailers, whether it's tariffs. He did talk specifically about raising prices. He said over time, slowly. He doesn't think folks are trading down when it comes to merchandise and goods, but does see that, that we're passing along tariffs. But again, I think he seemed to say it was kind of happening gradually, slowly. So interesting to see. That company, by the way, $5.7 billion market cap, stock's down about 31% year to date.
You didn't mention Icebreaker, did you?
I did not. What is Icebreaker?
Icebreaker, it's the merino wool from New Zealand.
Oh.
Very comfy, very soft.
Really?
Yeah.
Really?
Oh, yeah.
Icebreaker. Something
yeah, like if you need it's like a hiking shirt that, if you're going to be in the woods for 5 days and you're not going to have a washing machine.
Does this look like it's in the woods for, no,
all right.
Actually.
Anyway, Icebreaker.
It could. No, I think it's really important in terms of what's going on in the retail space, right? And we're just thinking about what's going on with consumers. So this is an important week. We're going to get the jobs report on Friday. We get some more jobs data tomorrow. We have a Fed hearing for the next possible Fed governor, another Fed governor that would certainly be maybe more sensitive, potentially, to President Trump and his wishes. We should be careful of that. I think sometimes people get into a role and they're going to listen to the information data presented before him.
Look, we're talking retail, we're talking the consumer, we're talking the economy. In just a minute, we're going to be speaking with Rick Caruso of the Caruso Development Corporation. We're going to speak to him in just a few minutes. Before that, though, a check of the day's trade and top business stories as we do get about 90 minutes from the close. Here's Lisa Mateo in for Charlie.
You got it. And we have a bit of uncertainty in the markets. It's kind of around the Fed independence, also what it means for inflation, interest rates. You had Federal Reserve Board of Governors nominee Stephen Myron. He says he intends to preserve the independence of the FOMC if he's confirmed. That hearing taking place tomorrow. Let's head over to the markets. The Nasdaq up about 0.4%. We have the Dow down 0.5%, and the S&P 500 is little change, down about 2 points. In the yield space, the 2-year 3.61%. That's down 3 basis points. The yield on the 10-year 4.21%, and that's down 5 basis points. Gold reached a fresh time high. Thoughts of interest rate cuts kind of boosting its appeal. We have COMEX Gold up nearly 1% at $3,625 an ounce. And over to oil, WTI crude right now at $63 a barrel. It's down about 2.5%. Finally, the Trump administration moving to block the development of more offshore wind projects. That's including New England Wind 1 and 2 offshore wind projects in Massachusetts. So we're keeping a quick eye on wind stocks. For example, GE Vernova, their shares down 2%, and we have Eversource Energy down nearly 1%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now, wherever you get your podcasts. I'm Lisa Mateo. That is a Bloomberg Business Flash.
All right, so appreciate it, Lisa Mateo in there for Charlie Pellet. Well, earlier we got a read on the U.S. economy courtesy of the Fed Beige Book. In keeping with that, we have a guest who has a very informed view on what's going on in the U.S. economy. His firm has over 2.5 million square feet of property assets, all owned and operated by Caruso, all capital coming from within. The assets include upscale retail, resort, office and residential properties across Southern California. He and his firm have been investing in and developing property since 1987. He's a philanthropist, also the president of the LA Police Commission, was part of the board of water and power commissioners out in LA, and has been involved in politics, notably running as a candidate for LA mayor in 2022. That's not all. He leads a nonprofit aimed at accelerating private sector involvement in the LA area's massive rebuilding effort after those wildfires earlier this year, is known as Steadfast LA. A lot to get to with Rick Caruso. He's founder and executive chairman of Caruso, as we said, the privately held real estate company. He joins us from LA. How are you?
I'm doing great. Thanks for having me on. How are you?
We're doing okay. Try to take in all the information that seems to come at us nonstop. I'd love to, if we may, Rick, start big and broad with you. The U.S. economy, you have a great vantage point. How would you describe it right now?
I think it's still very robust, to be honest. Now, the data that I look at is obviously off of our properties, and our properties are growing in terms of attendance on a double-digit basis year over year, so that's very strong. Our sales per square foot are continuing to grow at a very strong pace, and we have a lot of demand for retail space. So retailers, the best-in-class retailers are growing. You take a look at a broader picture, I think there's a little bit of softness out there in some of the categories. Luxury is not growing as much as it has. There's some luxury retailers that are suffering a bit, but I'm still pretty bullish on the consumer in the United States.
We should remind everybody, the properties and the developments that you've done have really served at the higher end of the consumer. People even outside of the Los Angeles area would be familiar with the Grove, for example, or perhaps Miramar in Montecito, just around Santa Barbara. But the vast majority in the Southern California area. What about Southern California's economy, that economy that you focus on? What have you noticed in terms of changes in the last couple of years as we've heard this steady drumbeat of information about people leaving the region because of the regulatory environment, the cost pressures, what have you?
Well, I think you're right, and I think it's a challenge. So when you take a look at LA City, in particular, LA County, you do have a very overregulated, tough business environment, and it's very tough, especially on middle or small businesses, to operate in the city because of the cost of operation. So you do have businesses leaving. And that's troubling because the backbone of our economy in Southern California are the small businesses. So, one of the things that we push for, I push for as just a business person and a member of this community, is to be more business friendly and to start deregulating so we can grow businesses in the Los Angeles region. And I think as a state, we have a problem with that. We have businesses leaving the state of California, going to regions that are more business friendly, have less red tape, allow businesses to thrive on a much easier basis. So, hopefully the tide will change on that. But it's certainly an issue in Southern California, and I think California in general.
Yet you remain, Rick. You have not moved to Arizona. You have not moved businesses to Arizona, to Texas, to Florida, these areas of the country where people from California have been going as a result of regulatory easing, one could say. Will you stay in California?
Well, I'm bullish on California. I'm going to stay in California. I believe in it. I think we should be leading the nation in California. I think we should be leading the nation in Los Angeles. And I also have a practical problem. You can't pick up large projects and move them. I can't pick up the Grove and move it. So I have to remain engaged, bullish, and hope we change the trajectory. And I think we will. I really do. I think people are at a point, certainly in the Los Angeles area, that they've realized that the path we're going down is not sustainable. We've got a budget in LA City that's $1 billion out of budget. We have revenue decreases in LA City because businesses have pulled back and left. And we don't have new capital and investment coming into LA like we should. They're going into other regions, even immediately outside of Los Angeles. You have cities that are doing incredibly good jobs. The city of Glendale, the city of Culver City, that are more business friendly, are safer, cleaner, more supportive of great neighborhoods, and they're attracting the business at the cost of LA City. So we've got to change that. But I remain optimistic that change is coming soon.
How are politics getting in the way of all of this? And I ask it, Rick, you've got California Governor Newsom and President Trump really in kind of high stakes feuds over a bunch of issues, whether it's California's universities, their environment, redistricting, and other issues. I mean, talk to me about that, and whose side are you on in all of this?
Well, I'm on the side of the people of LA and the people of California. Here's the problem that I have with the battle that's going on. We've got some really serious problems that need to be dealt with. Crime, shortage of housing, homelessness, et cetera, the cost of living in California. Having an argument between the governor and the president, between the mayor and the president, a lot of name calling going on, doesn't advance anybody's cause to solving these problems. So what I hope is that we get past the rhetoric, figure out a way to sit down, find some common ground and work together. Here in Los Angeles, we have 300,000 acres in Pacific Palisades, Malibu, and then also at an Altadena that was burned to the ground, the size of 2 Manhattans, to put it in perspective for New Yorkers. We need federal help. We need federal funding, and we're getting none of that. And I don't think, as the bickering is going on and the name calling is going on, that serves any purpose in advancing the negotiations or the discussions in getting federal help in Los Angeles.
We're speaking with Rick Caruso, founder and executive chairman of Caruso, the privately held real estate company. On the federal aid, on the federal funding, have you had conversations with President Trump or members of the Trump administration expressing the need, in your view, for federal help for California in the wake of these disasters?
I've had those discussions not with the president directly, but I've had those discussions with intermediaries. I've certainly had that discussion with our governor. And we need to find a way to get those discussions at a higher level and more productive. I know there's some talk, Governor Scott or Senator Scott was out here in Los Angeles and talking about it. But it really is critical path because you have hundreds of thousands of people that have been displaced. You got jobs that have been lost. You have a massive, massive rebuilding effort that's going to take tens and tens of billions of dollars in infrastructure. So we need the federal help. It just has to happen.
Well, you know,
it should happen.
Yeah, no, I hear you. And you've, since the fires, I know Tim and I just kind of preparing for this, listened to a lot of conversations you've had with various individuals about this in terms of what needs to be done. You know, what's interesting is need more federal help in terms of the rebuilding efforts. So then how do you feel when President Trump illegally used federal troops in LA? I mean, if you were mayor there, how would you respond to President Trump and his threats and use of troops? Like, that's going on when, obviously, as you say, there are efforts needed to do the rebuild.
Well, I've been very clear. The federal troops coming into LA were wrong. And I don't think it should have ever happened. I would have gone to court immediately. They finally did go to court. As you know, the court ruled that it was an illegal use of those troops to come into the city of Los Angeles in this region. So it's not right to be doing that, and we don't need to be doing that. I mean, that just, this power grab that's going on does not advance the cause for any, it just doesn't. And the division between the politics is harmful to the residents of Los Angeles. We've got to find some common ground. We've got to act like grown-ups. We've got to put our differences aside as elected officials and figure out how to work together. And so I would hope that our elected officials find a way to drop the name calling, maybe get on a plane and get over to Washington and see if we can find some common ground to work together. We also have the Olympics coming here. So Los Angeles is going to be the world stage for the United States. And we need to be putting our best foot forward. And we're going to need to be making a lot of investments in order to do that. And again, we need to have the help of the federal government to do that.
So, Rick, I'm kind of waiting for the flood of my emails to come into my Bloomberg, because I think people who are listening would say, well, this is the kind of individual you do want in politics. So what's your latest thinking on maybe running again for mayor or possibly governor of the state of California?
Well, I'm seriously looking at it. And I've got a team of people that are working on it, and I'll make a decision soon on that. And I'm looking at both paths, and there's good opportunities in both paths. But now I'm just remaining focused on what we're doing at Steadfast, making sure we're getting people back in their communities as quick as possible. Yesterday, I spent the afternoon in Altadena. We were giving out grants for small businesses to get reopened in Altadena. We're doing the same in Palisades and in Malibu. So those kind of efforts are incredibly important to me because, again, small businesses are critically important for jobs. And we're giving out about $1 million in grants over the next couple of weeks. So that's what I'm going to stay focused on for now. Politics will come down the road fairly soon.
All right. We want to talk about some of those efforts you're doing in terms of the rebuild. I got to ask you, though, if you do run or make a decision, would it be for mayor or for governor?
I don't know yet. We're going to find out. I'll let you know.
Okay.
We're studying both.
I'm going to hold you to it. I'm going to hold you to it.
Hey, Rick, I'm curious about just fire resilience in California, especially in the wake of Palisades. I'm from the Central Coast. I was glued to watch duty because of the Gifford fire just a couple of weeks ago. I mean, I spent 10 days just refreshing that thing, watching the progress of that fire. What is the right way for Californians to be ready for what has become just a part of daily life for a big portion of the year?
Well, we have to have very smart brush management. One of the problems in the Palisades, we had 40 years of brush that were not maintained by the state, the county, or the city. That was rocket fuel. We have to have water. I mean, it was an unbelievable circumstance that we had reservoirs that are empty. So the competency level at the government and being prepared is critically important. LA City was not prepared for this fire. This fire, in my opinion, and I think in most people's opinion that have seen the facts, is this fire could have been prevented, certainly significantly mitigated in terms of the damage. And then we have to be encouraging people to build with non-combustible materials. Fortunately, the village that we built survived it, but it survived it because we were prepared to fight the fire. But equally important, we built it with non-combustible materials. And so it was able to withstand the fire around us. And we had a lot of smart people doing some things. So we can build better and smarter, but we also have to have better infrastructure. The fire hydrants need to work. They were not working in Los Angeles. The reservoirs need to be full. And this is an opportunity right now to rebuild Malibu, Pasadena, Altadena, and Palisades in a way for the next 100 years and to get the right infrastructure put in. It's an incredible opportunity to create these communities for the future. And that's why we need to work with the federal government, get the right federal funding, and get some smart leadership locally that builds it back properly so that we can withstand fires and other natural disasters in the future. It can be done.
Rick, the nonprofit you are leading, as we said, called Steadfast LA. You've got companies such as Netflix, Amazon, JP Morgan Chase, CBRE Group, so many who are working to restore these communities, but you guys are looking at everything. You're using AI. How long do you think it's going to take for the rebuild? And ultimately, are we talking about kind of the cities of the future in terms of the materials used and how it's done?
I think it's going to take, there's going to be phases. I look at it, what's going to be happening 1 year from now, 3 years from now, 5 years from now. 1 year from now, for example, the little downtown of the Palisades is going to get reopened. We're going to rebuild the park. Steadfast is leading the park rebuilding. Schools are getting back reopened, and we're involved in supporting the school systems and getting reopened. Same in Altadena, same in Malibu. I think in 3 years, you're going to see a lot of the homes back and running. We have some really encouraging programs with an alliance of builders who are coming together to buy in bulk, be able to build less expensively. And so that's really important to do. And I think in 5 years, we're going to be in pretty good shape getting these communities back on its feet. The biggest challenge we have, honestly, is the lack of diligence, the lack of urgency from the local governments to get permits issued. And we've got to speed that up and cut the red tape, both in the county and in LA City, so people can rebuild.
Hey, Rick, before we let you go, I want to talk a little bit about your family foundation that's been involved at this point for more than 30 years in Watts, the Caruso Family Foundation. And it serves organizations, a slew of organizations in the area. And I'm just wondering, the focus is on healthcare, it's on education, at-risk kids. I'm wondering why we need organizations to step in and fill the gap that isn't necessarily provided by other organizations. Why do we need the Caruso Family Foundation to do this? When will your work be done and you won't have to help bridge that gap?
Well, I don't think our work is ever going to be done, but I have to tell you something. It's one of the most rewarding parts of my life and my wife's life and my family's life that we can help kids that are at risk, living at or below the poverty line. And you bring opportunities to them and the right education and the right support. We have kids that are living in some of the worst and toughest conditions in LA, and they're now at Harvard, MIT, Georgetown, USC, UCLA, and they're just excelling and doing it on their own because they had the right ecosystem around them and the right start and the right support. And government alone can't do everything. It never has been able to. You have to have philanthropy. And people need to give back and lean in and support churches and schools and all these great organizations that we have out there. And what I would argue for is we need more people to be leaning in. We need more foundations to be giving back because the reward and the payoff is so great and so huge. And it really does change these communities because these kids are coming back and helping others. I just find it one of the greatest parts of my life is being involved and being able to see these kids just take off and do great things.
Well, we're going to end it on that optimistic note. That makes us, I think, all feel really super good. Rick, thank you so much. Really appreciate your time and efforts. And we're going to mark our calendars to check back with you about maybe that political decision you may make very, very soon. Rick Caruso, thank you so much. Be well, founder, executive chairman of Caruso, joining us from LA.
I'm Tim Stenovec along with Carol Massar. Let's take a look at some stocks on the move. With us, we've got a Bloomberg News equities reporter, Alexandra Semenova. No shortage of stocks to choose from today, Alex.
Yeah, but it's really all about Alphabet today, Tim. The tech giant avoided a breakup after a U.S. judge ruled against the government's most onerous proposals, including a forced sale of its Chrome browser. This is a massive court victory, not just for Alphabet, but for big tech broadly, in what is arguably the biggest antitrust case of the last 3 decades. Shares of Alphabet surged as much as 9.2% today. That was the highest in 5 months. On an intraday basis, they're up about 8.2% right now. A lot, especially when you consider the outsized sway that it has on the index. Google will have to make some concessions, though, including sharing online search data with rivals and ending exclusive contracts for distribution. Apple is also a beneficiary of this because they'll work together, on their search engine. Alphabet shares are also up about 3% right now. And just for some context here, guys, the outsized weight of these big tech companies, Alphabet today has added about 16 points to the S&P 500. Apple, another 13 points. The index is up only 5 points.
So Apple up 3%, and then Google just off and running, as you said, up about
off to
8%.
The races.
From high tech to chicken. That's where exactly where I want to go.
How do you do that?
That was a good transition.
Thank you.
Some really bad behavior apparently happening at Tyson Foods. It said that its supply chain chief left the company after violating internal rules. They didn't specify exactly what he did, but this is the second major executive departure for improper behavior just in over a year for this company. Tyson also appointed Devin Cole. This is the head of its poultry business. To chief operating officer, signaling that they may make some more big changes at the top level as they figure out their succession planning. Stuart's departure also comes a little bit more than a year, as I mentioned, after John Tyson, that is the great grandson of the company's founder, was permanently removed as chief financial officer, again, following drunk driving.
Some things coming home to roost, you might say.
Oh, Carol.
But
well done, Carol.
All right, the Campbell's Company, CPB.
I like this one a lot because I'm a huge fan of Milano cookies. Do you guys like them?
Yes.
They're the best ever, and apparently they are what helps.
Straight Milano or mint Milano?
I'm a straight Milano person,
Okay.
but I do like the mint ones as well.
I'll eat any of those cookies.
Yeah, exactly. Can't go wrong with cookies, especially for this company because their snack business outperformed thanks to people just buying cookies, eating them up. Adjusted earnings per share of They had adjusted earnings per share of 62 cents. That topped estimates of 56 cents. So nice outperformance there. They said, in cookies, we gained share as we grew consumption during the quarter.
Got that right.
Beverage Farm to the rescue for Campbell's.
Alex Semenova, thank you so much. Check out our Stock Movers podcast, 5-minute episodes, biggest winners and losers in the stock market. Find it on Apple, Spotify, or anywhere you get your podcasts. On TV, the close is coming your way in just a moment. Tim and I continuing on Bloomberg Businessweek Daily.
Mark Gurman next. This is Bloomberg.